Welcome to today's Explainer. We're diving deep into Franco-Nevada Corporation, or FNV. It's a gold-focused giant, but its financials, man, they are sparking a massive debate among analysts right now. We're talking about a company operating in one of the most physically demanding, capital-intensive industries on Earth, mining. Yet it somehow prints financials that look like they belong to a Silicon Valley software startup. How do they pull that off? And, maybe more importantly, are those headline earnings actually as good as they seem? Let's get right into it. Okay, let's start out of the gate with a truly staggering number. 65.7%. That is their reported net profit margin over the last 12 months. Just take a second to let that sink in. For a company heavily tied to pulling rocks out of the dirt, a nearly 66% net profit margin is literally unheard of. This specific metric is exactly why Franco-Nevada's profitability and earnings quality are right at the center of such a fierce market debate today. So, to figure out how they achieve these software-like margins, we're going to follow this quick roadmap today. We'll hit the ultimate mining landlord, the bullish growth story, the earnings quality debate, leadership and ESG milestones, and finally, future catalysts and risks. All right, Section 1, the ultimate mining landlord, how FNV prints cash without the overhead. You see, Franco-Nevada isn't your traditional mining company. They don't deal with heavy machinery, massive payrolls, or escalating diesel costs. Think of them more like the financial backer, or really the landlord of the mining world. They use what's called a royalty and stream model. In plain English, they hand over upfront cash to mining operators to help them build or expand a mine. In exchange, Franco-Nevada gets a percentage of future production or revenue. It's a brilliant setup because it gives them all the upside of gold, silver, and energy price jumps while completely shielding them from the messy operational costs of actually digging the metals out of the ground. And this perfectly highlights the sheer safety of their model. Look at these stats for a second. They boast a massively diversified portfolio of 121 cash flow producing assets. In 2025 alone, they generated around $1.66 billion in adjusted EBITDA. But here is the absolute kicker. They hold zero debt, none, and they're sitting on $3.1 billion in available capital, just waiting to be deployed. Plus, their risk is super spread out. They project a maximum of just 12% of revenue will come from any single asset in 2026. Moving on to Section 2, the bullish growth story, Q1 2026 earnings beats and record highs. The numbers they just dropped are seriously turning heads across the financial sector. Franco-Nevada absolutely crushed first quarter expectations. Earnings per share came in at $3.27, beating estimates by nearly 13%, and revenue, a massive $894.8 million. To put that into perspective, that is a staggering 77% year-over-year revenue surge. This was heavily driven by soaring gold and silver prices for sure, but also by fresh contributions from 4 brand new acquisitions. Overall, total gold equivalent ounces sold jumped 8%. And just to sweeten the pot for both retail and institutional investors, the company declared its 19th consecutive annual dividend increase. 19 years! In a sector notoriously famous for wild cyclical swings and totally unpredictable cash flows, raising your dividend for nearly 2 decades straight is a massive flex. It really reinforces their track record of consistently generating and returning true shareholder value. CEO Paul Brink actually highlighted this momentum recently. He pointed out that their core strategy, backing strong management teams, is just paying off beautifully. He specifically called out operators like G Mining Ventures and Discovery Silver. Franco-Nevada provided the financial packages for them, and now those operators are vastly outperforming their peers. With this model, when their partners win, Franco-Nevada wins, taking their cut right off the top. But, well, every gold rush has its skeptics, right? Let's pivot to Section 3, the earnings quality debate. Are non-cash earnings inflating the numbers? Because despite those flashy headline numbers we just talked about, this debate perfectly frames the current divide in the market. On one side, the bulls see an absolute cash machine with a growing long-life portfolio and a forecast of 13.6% annual revenue growth. But then you have the bears. They are throwing up major red flags about paying a 34 times priced earnings premium. Why? Because they argue that this massive 122% year-over-year earnings rise might be heavily tied to accounting-driven non-cash items, rather than actual cash hitting the bank. Skeptics point out a pretty critical discrepancy here. Yes, the trailing EPS shot up from $2.87 to $7.11 over the last 6 rolling quarters. But if you zoom out, the 5-year historical earnings trend actually shows a slight 0.5% annual decline.
The bear argument basically boils down to this. If a big chunk of this recent surge isn't structural, cash-in-hand profitability, Franco-Nevada could really struggle to sustain these margins if global commodity conditions start to cool off.
All right, Section 4, Leadership and ESG Milestones, Transitions at the Top, and Sustainability Awards. Setting the financial debate aside for a second, let's look at who is steering the ship. The crucial takeaway here is a great balance of continuity and fresh experience. Founder David Harquail, who has been instrumental since the 2007 IPO, is stepping down his chair to become chair emeritus. Taking over as the new independent non-executive chair is Tom Albanese, a highly seasoned mining executive with prior CEO stints at Rio Tinto and Vedanta. Meanwhile, Paul Brink remains the steady hand as president and CEO. Furthermore, the company is absolutely locking down its reputation as a responsible operator. They recently scored a top-tier AAA rating from MSCI, and they were recognized in Corporate Knights' 2026 Global 100 Most Sustainable Corporations list. Plus, following their annual meeting, they now boast 44% board diversity by gender or ethnicity. They're also actively cutting down corporate emissions, which is a huge plus for modern institutional investors. Finally, Section 5, Future Catalysts and Risks. What is next for Franco-Nevada? On the bullish side, a massive upside catalyst just materialized. The Panamanian government has officially approved the processing of stockpiled ore at Cobre Panama. If this mine eventually ramps back up to full capacity, it could independently add 30% to Franco-Nevada's overall growth outlook. That is huge. Beyond that, they're waiting on a final investment decision from Glencore on the Corcohuico project, and there's more than $250 million set aside just for exploration on their Canadian assets alone in 2026. The upside optionality here is vast. However, we have to impartially weigh this against the macro risks. Franco-Nevada's incredible margins are still highly sensitive to global commodity prices. If gold, silver, or oil prices drop, their revenues drop right along with them. And because they are so globally exposed, things like geopolitical conflicts, sudden changes in local permitting, shifts in taxation, or new tariffs could really squeeze those legendary profit margins tight. So as we wrap up this due diligence explainer, I want to leave you with a final thought to chew on. We know the royalty model shields them from operational inflation, and we know they have zero debt and a cash printing portfolio. But does the fundamental safety of this elite, diversified model justify paying a 34 times premium price, especially amidst all those active debates about the actual cash quality of their recent earnings surge? That, my friends, is the ultimate question for anyone looking at Franco-Nevada today. Thanks for tuning in.